So imagine having the ability to read any market like an open book, to spot trends as soon as they begin, and to anticipate price movements with precision. Simple market structure can be the game changer you've been searching for. You know the basics. When prices are consistently rising or falling, it creates trends. An uptrend is shown by each new high being higher than the previous high. In ICT terms, that's a break of structure, a BOS. Also, each low remains above the last low. That bullish trend keeps going until the price dips below a past low point. That's also called a change of character, a CHOC. Trends start to weaken when the price fails to make a new high after the last rise. That's when I know the buyers may be losing their grip. A downtrend is shown by the price making a new low that's lower than the last low, and also not being able to reach as high as the previous high each time. That downward pressure from sellers continues the bearish move, and the trend will stay bearish as long as those lower highs and lows keep occurring. But once we see a high that tops the last high, that's a sign the trend could be reversing to a bullish trend. Sometimes the market goes sideways between trends when highs and lows are roughly even. This consolidation period has the price bouncing between supply and demand in a tight range. It can stay stuck like that for a while as buyers and sellers battle for control. The sideways price action is broken once price pierces and stays above the usual high points or under the normal lows of the previous trading channel. That breakout could mean the start of an uptrend or a downtrend developing from there. For a trend to be considered strong, the price needs to make new highs and lows. It must print new BOSs, breaks of structure. So in an uptrend, each swing high has to rise above the previous swing high for the bullish move to continue. Looking at this chart, it's clear we've been seeing higher highs and higher lows consistently over time. That tells me the buyers are dominating the market and driving it to newer high ground with each push. If prices just traded sideways or dipped below old highs, that would signal weakening momentum. And on the downside, new lows must break under previous lows for a downtrend to persist. As long as lower lows continue forming, sellers are still in control of the move down. For an uptrend to really be considered strong, it takes more than one candle breaking above a high. Seeing prices close above past resistance multiple times in a row strengthens the case that buyers are in control. Just one candle retesting highs doesn't guarantee the move will hold. But if we get multiple candles closing firmly above that level, that's a sign the market is accepting the new higher trading range as the normal territory now. Sometimes a candle will break above it, but then sellers quickly move it back below the high. If there's no follow-through with strong closes after, that tells me the move wasn't as legit and the trend may not continue smoothly from there. That could be a liquidity run. So on my charts, I like seeing consolidation with multiple closes after a breakout, and not just one close above resistance. This confirmation is what I look for to feel more solid about trend continuing its run strongly, rather than potentially just stalling after just one false breakout. Now, when you analyze market structure, certain swing points stand out as more significant than others. These strong highs and lows are important because they're the levels that actually caused structure to break one way or the other. In an uptrend, the higher lows are key since they pushed prices above preceding higher highs. And in a downtrend, the lower highs are crucial as they drag the market under previous lower lows. These strong points that triggered the breaks of structure are considered protected in their trend. So if the current direction keeps playing out, the market should hold above higher lows or below lower highs. Seeing which swing points break through prior boundaries tells me a lot about where strong demand or supply likely sits, and it helps identify areas the trend is expected to pull back to at minimum if it does reverse temporarily before resuming its path. When you analyze structure, certain swing points appear weaker than others. These weak highs and lows were formed during counter-trend price action, like a high made during a bearish pullback in an overall bullish market. In an uptrend, weaker highs would be levels created by a short dip, potentially marking an area buyers could push above soon. And in a downtrend, weaker lows form on small bounces that sellers may look to break under going forward. And this is known as internal structure, all structure between key swing high and low points without breaking the key swings. So here's how you find internal structure. First, price breaks structure to the upside. You mark the higher low, the lowest point that caused the swing high. Then, as price starts to pull back, you mark the higher high. All structure between these 2 points is internal structure. If price breaks up, you mark the BOS to the upside. And once again, you mark the higher low, the lowest point that caused the swing high. And to stay consistent mapping market structure, you need to use the same methodology picking your key pivots. A swing high is the highest point that caused the swing low, and the swing low is the lowest point that caused the swing high. Now, trends and structure shifts start on lower timeframes before progressing up. Even huge trends have to begin small somewhere, and those tiny shifts in immediate demand and supply will eventually compound over time, resulting in breaks of structure and change of characters on increasing period lengths. So a structure change on the hourly timeframe may just be order flow evolving on the daily timeframe. And this shows markets are fractal. What looks important on one scale just looks like background noise on wider spans. But together they form one connected picture, with lower charts continually shaping higher ones. And looking across timeframes provides context on where a move may be in its process of progressing or consolidating. It's not good enough to just look at one timeframe when you analyze market structure. I need to make sure any signals I see will fit with what larger charts are showing. So if I want to trade something I noticed on the hourly chart, I also need to check the 4-hour and the daily timeframes to see if those higher views support the same market structure. I don't want to take a trade that looks good only on a lower timeframe if the bigger pictures are telling a different story. Finding consistency between timeframes helps validate any setups I see forming. Paying attention to conditions on longer charts helps make sure I don't miss something important happening at higher levels. And getting confirmation across time periods helps reduce the chances of being whipsawed by the temporary moves on a single scale. When you analyze market structure, it can be easy to overanalyze and get unsure about which exact highs and lows matter most. Too much guessing leaves things open to errors. So I like the idea of having a set method using the 50% Fibonacci retracement to mechanically determine what swings are or aren't significant enough to count as important turning points. If a move retraces less than 50% from the previous swing, I'll ignore it as just noise and not a meaningful cycle high or low. But anything that moves at least 50% establishes a valid reversal in my view. Focusing only on the solid waves that create proper support and resistance levels through 50% or deeper pullbacks should lead to cleaner structure analysis. It avoids getting hung up on tiny, irrelevant short-term moves. To me, using this 50% Fib rule seems like a wise way to analyze market structure without too much subjective guessing involved. If you trade ICT concepts, you might combine this rule with the discount and premium zones. It's a basic idea where you draw a Fibonacci retracement between a significant high and low using just the 50% level. This horizontal line then divides the previous move into two parts. The upper half, above 50%, is when the price would be considered at a premium, meaning closer to the top of its recent range, whereas below 50% puts it down in discount territory, near the lows. The midpoint helps mark the theoretical fair value level within that swing, and it gives you defined zones to think about entries and exits. The strategy involves selling when the market reaches premium prices towards the higher region, and looking to buy dips down into the discount area below the midline when it's closer to the lows of its recent trading range. So keeping trades aligned with this premium discount dynamic could help add an extra edge on top of pure trend following. Now, trending markets can continue rallying or falling forever. Sometimes you start to see the momentum drying up as smart money take profits or new information impacts the market. When we've been in a clear uptrend, it's important to recognize signs it may be changing character. One hint is if prices fail to go past the most recent high, showing resistance is stronger now. Another sign is when support levels get retested, but hold the price right above the last swing low. Both signals together tell me we could be shifting from a trending phase into more consolidation. I like to see a sideways range form within the context of the overall cycle direction. So until the last meaningful low breaks lower on this time frame, the bias is still bullish. Paying attention to these transitions will help you adjust your structure analysis and your expectations from what phase the market seems to be moving. Something that gives context on the underlying strength is analyzing how far each new high or low is extending beyond the last swing. Basically, are the cycles growing in magnitude over time? Even if we've hit a sideways period now, looking back, we can measure the height of the previous most recent wave relative to the previous run. And in this case, the latest wave higher was created at a bigger distance versus before. When each new swing is larger than the last, traveling a greater distance, that tells me the dominant buyers or sellers are showing more momentum each cycle. It suggests the imbalance of supply versus demand is increasing with each wave. So seeing progressively amplifying waves is a sign to me that the cycle still favors the trend's direction, even if we've entered into a consolidation phase. That's why paying attention to how far price waves are extending can provide context beyond just looking at timeframe patterns alone. And it's not just about how far a new high or low extends, but also how quickly it gets there. Was the wave swift and impulsive, or long and drawn out? When analyzing market structure, one aspect I try to determine is how many candles it took to travel between swing points. A faster trajectory that establishes new price levels seems stronger to me. In this case, you can see that the latest run lower was made more swiftly than the one before it, using fewer candles. That tells me the sellers had increased their strength, driving the price lower. Seeing new highs achieved at a faster speed with less time spent consolidating reinforces the underlying cycle's health. It suggests the imbalance between supply and demand is increasing rather than slowing down. So very important, paying attention to both distance and speed provides more context beyond just structure levels. Together they help paint the picture of a cycle's relative health and market sustain momentum or not. One tool I found helpful is drawing a trend-based Fibonacci extension between major highs and lows of a cycle. Specifically, it connects the lowest point, the highest point, and the low of any pullback in between. For the current leg up in this example, I've drawn it from points A to B and used the low of this consolidation. That projection gives me a defined target of where the next layer of resistance may come into play if the trend keeps advancing as expected. Having these calculated levels gives me predetermined profit benchmarks to consider taking partial profits or adjusting stop losses upwards. The goal is hunting for an even bigger payoff on the trade, and in this case, once price neared that 100% projection number, buyers seem to have started cashing their profits, which triggered a retracement. So this tool is a useful reference for an exit strategy too. Trend-based extensions are a must-use tool in your market structure analysis. They objectively flag probable obstacles for the price as the market unfolds cycle by cycle.